Hello and welcome to Portfolio Matters. In today's share talk, we will be talking about the American natural gas company, Cabot Oil and Gas, and about the outlook for the natural gas market in the US and the Marcellus shale in particular. But before we do that, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So, Keith, tell us about Cabot Oil and Gas.
Okay, well, first of all, thank you to our viewer Herman for putting me onto this story, which I think is a very interesting story, both about the way companies can mislead shareholders and about the outlook for US shale gas. Okay, so this is Cabot Oil and Gas. It's an American company. And the share price over the last few years, basically pretty stable, not going anywhere. And it produces natural gas from the Marcellus shale, which is in the northeastern US here. New York is around here. So it is the most nearest shale play to the industrial centers of the northeast. Okay, so it has a market cap about 7 billion, revenue about 1.5 billion. It's got debt of about 970 million, pays dividend, and PE ratio about 10. Okay, so this story will be about the remaining reserves of Cabot Oil and Gas and how the bold numbers reported by the company disguise a multitude of evils, basically, and cannot be relied upon. The bottom line is they're running out of room to drill in their core area of the Marcellus. A lot of their reserves are in the non-core area where they will have much higher costs. So the bottom line is, going forward, their costs are going to go up substantially. And that has a read-through to US natural gas prices. And the US produces a lot of its electricity from natural gas. So it has a read-through to power prices as well. The production, of natural gas in the US over the last 20 years. So you will see back in 1986, the US was producing under 20 billion cubic feet, the trillion cubic feet of gas. And then starting in 2006, you saw a steady increase in shale gas production, which allowed the US to essentially double its natural gas output in those 15 years, 20 years. And as a result, you see US natural gas imports decline, and actually its gas exports increased. And you see the proved reserves, so how much gas they've got left, massively increased over that period. And this is the price chart, and you'll see that as a result of the massive increase in US natural gas production, that prices broadly declined over the decade from 2011, although there are obviously spikes in the winter. And as production outstripped demand, Cabot have all their assets in the Marcellus. Okay, so this is the latest report from the EIA on the Appalachia region and natural gas production in essentially the Marcellus. And you can see down here, bottom right, this has been the historic production. So enormous growth. And then recently plateaued. And you'll see the rig count has declined, obviously, as prices collapsed, in part because of reduction in demand because of COVID. But also, you'll see that legacy production from old shale gas wells, and remember that shale gas wells decline very quickly. So the production from each well can fall by 50% over the first year and in subsequent years. So as production increases, you need to keep on drilling to offset decline and keep production up. And this shows you the extent to which wells decline and how much you need to keep on drilling to offset declines in previous years. So if you look at 2012 production, you'll see that the production from those wells had essentially gone down by what, 50% over the first year. And so as you increase production, the total sum of the declines really becomes quite stark. You now need to be producing an extra 5 million cubic feet. That, frankly, there is a problem in the metrics, because you see here it says million cubic feet top left, whereas Cabot alone are claiming to produce trillions of cubic feet, and I'm not sure which is true, but anyway.
This is daily though, Keith, so maybe
right.
It's daily versus annual.
Okay, right. Thank you, Richard. That may well have explained it.
Yeah.
But the bottom line is you need to keep on drilling and producing a lot of natural gas just to offset declines.
And also it looks like the best wells have been drilled and the later wells decline much more quickly than the early wells.
We will get on to that, mate. And this is total US shale gas production.
Daily.
So, massive increases. Shale gas and natural gas are important because US electricity is very heavily dependent on shale gas or natural gas. It's 38% of electricity production. Renewables are growing, but only represent 1% of
18%.
Sorry, 18% of electricity production. Sorry. Okay, so this is from the Cabot website, and you will see, according to them, everything is hunky-dory. So US net company production was up, reserves are up, costs are down, development costs and finding costs are down. Everything looks great. And earnings per share are up. This is all in the 2019 annual report. Obviously, the 2020 will not have been as good because prices collapsed, but return on capital employed was up in the years to 2019. And they've been returning capital to shareholders, return of capital employed of 22%. I mean, what's not to love? And in 2019, they were profitable. So you see here revenues of over 2 billion and actually operating profit of 950 million. Yeah. Everything looks good. They do have debt, though, of 1.1 billion, although that has fallen in the recent year to 970 million. Okay, so, but this is a story about reserves. And you'll see here they're reporting reserves and reserve increases during 2019. But let's get on to the but. So thank you once again to Herman for putting me onto this story. Twitter contains some people who do the hard work. And this man, who goes by the handle NextWaveEFT, has gone through all of Cabot's land and the wells they've already drilled, and he tells a compelling story. And this is the story. So these are the Cabot lands. The yellow areas are land they own but have not yet drilled, and the black lines are their existing wells. And so in total, this story is that Cabot have a lot of land left, but what they're doing is they're adding up the total acreage of their land and then dividing by a number of how much they expect to get out of that land. And that is misleading because a lot of their remaining land is non-contiguous, very difficult to drill, and will hence be either not drilled or much more expensive to drill. And also they're running out of land in their core area. And there's a fundamental difference in the economics of drilling your core area, which are very productive, and drilling your non-core areas, which produce a lot less gas per well. So the raw reserve numbers hide a host of sins. And so you'll have to forgive the definition on this close up. But if we take a small area of the last chart, and if you look at the red dot here, that is one drilling rig. And you'll see what you want to do is from one drilling well, you drill a load of laterals. So in this case, you have drilled 8 or 9 laterals, which means you don't have to move the rig. You only have to set it up once. It's efficient. But if you look at, for example, this land mass here, just to the top right of the red dot, you see, how are you going to drill that land? You have a big chunk of it in the middle is land you don't own. So you'd then have to do 2 separate drills, one to the north and one to the south. And you would only be able to do what? A couple of laterals in the bottom, a couple of shorter laterals at the top. You know, your costs are going to massively increase. Okay, so in summary, what he is saying is that in 2019, the average length of one of their laterals was 9,000 feet. In 2020, it's going to be 8,500 feet. And he is estimating going forward a steady decline in the length of the laterals because they have non-contiguous land. Basically, the core of the Marcellus, he's saying, will be drilled out quite quickly. And then you're going to have to move into the non-core areas in the upper Marcellus, which have 40% worse results. So the bottom line is, as they move into these non-core areas, the estimated ultimate resource from each well will go down, their costs will go up, they will be a lot less profitable. That has negative read-through for both the cost of natural gas in the US and the production of US natural gas. And in the US, what we've seen over the last 15 years is essentially a supply shock in both oil and gas as shale gas assets have been exploited. And what this story is telling us is that supply shock, certainly in natural gas, is coming to an end. And then we will be once more into a balanced market where we're going to need to find new resources to maintain production with increased exploration and development costs. The easy gas will have been drilled out in the US. Okay, so in summary, be very careful about investing in natural resource companies such as Cabot, where the gross reserve numbers hides a multitude of sins. And also, this is a story that we will be covering going forwards, because essentially what this is saying is that natural gas supply in the US may be reaching a peak over the next few years.
And that would obviously have a consequent effect on the price, although there's plenty of natural gas around the world. If it has to be shipped in,
Yes,
as liquefied natural gas, it's a lot more expensive.
absolutely. And the Permian still has a lot of gas assets, but then you're shipping it across the entire country.
Yeah.
So when the Marcellus begins to deplete, and we know the Eagle Ford and the Bakken also have problems, then you should see that natural gas prices will begin to rise. Anyway, so I hope you've enjoyed that detective story. Thank you to Herman and Next Wave EFT for bringing that to our attention. And we hope to see you again soon. So it's, oh, by the way, press like and subscribe to the channel. So it's goodbye from Richard Wheater.
It's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.